The market moves that we've seen as of late have been stunning for some. How is it that we can still see so much positivity and bullishness in markets, given everything that we've seen headline-wise for coronavirus and everything else?
It comes from two things. It's monetary stimulus and fiscal stimulus. And monetary stimulus is the real driver of markets, that money is essentially free. M2, the measure of U.S. money supply, which is your coins and your bills in circulation, plus your current accounts, has grown at 24.5% over the last year. And that's a huge number. But historically, before COVID, the biggest that ever got to was 14% year-on-year growth. So basically, money is being pumped into the system, and it has to find a home. And with that, you see all asset prices moving higher, whether they're safe haven treasuries, gold, equities. The liquidity in the market is unprecedented, and that's the real driver of markets right now.
So Patrick, we're showing viewers right now and listeners on SiriusXM, what we're showing right now is a chart that Patrick has put up there of the M2 money supply in the United States, as he just mentioned. What I'm curious about is you see this spike higher. It has not led to inflation on certain fronts, though. Asset prices, yes. Oil and fuel prices, certainly no. Maybe food prices, yes, but that's because of some COVID-19 related supply chain issues. Are we on the verge of seeing inflation? It sure doesn't seem like it right now.
We're not on the verge of seeing inflation in everyday goods right now. So money supply historically fed through into real goods prices because when money was distributed, it got distributed evenly across the whole economy. If people had more money, they paid higher prices for things. But the way money supply and money generation is going right now, it's going to the rich, the institutions. Quantitative easing doesn't give money to everyone. Quantitative easing buys treasuries off of institutions, off of endowments, off of affluent people, and then they put that to use in other financial markets. So the quantitative easing part of it right now is not creating real goods inflation, it's creating asset inflation. And that seems to be the emphasis of the policy right now. I think we do have inflation probably years down the road because eventually this will be transmitted into the real economy as well. But right now, the mechanism creating liquidity is creating asset price inflation rather than goods inflation.
So it can't be that easy, though, Patrick, right? It can't be that easy. You can't just say, I'm just going to keep on pumping money into the system and asset prices will go on higher in perpetuity with no real repercussion whatsoever. What exactly are investors and traders missing about what the possible downside is in this kind of a scenario?
Well, it's unprecedented. So we're doing an experiment right now where you don't know the outcome. Japan's further ahead of the United States, further ahead of Europe in their experiment. And if you look at all the ETF holdings in Japan, the Bank of Japan owns 75% of them. So the end game may not just be QE of buying treasuries, expanding to corporate bonds. The Bank of Japan's already buying equities. There's going to be consequences. If inflation's the ultimate end game, I believe, of governments, of central banks, basically you have to print new money to pay off old debt. We've got deflationary pressures, which are beating inflationary pressures right now because the supply is coming back in the market faster than the demand following COVID. Basically, people are going out to work because they have to, but then they're staying in a little bit more than they would have otherwise, so the demand hasn't come up as much. The end game eventually may turn into actual helicopter money, which is more of an equitable distribution where it goes to all citizens, and that's when you'll get real goods and real higher inflationary prices. But it's an experiment right now, so no one knows with a fact where the end game of this will be.